everyone. I'm Ellen Myers, the Programs and Communications Director for the Newton Free Library. Thank you so much for tuning into the first session in this year's You and Your Financial Future series. The series will continue on Tuesday, July 21st at 7 o'clock in the evening with attorney Denise McCarthy speaking about estate planning and long-term care. And then on Tuesday, August 18th at 7 p.m., Toby Gerard will wrap up the series with a program on long-term care insurance, fact and fiction. Be sure to visit newtonfreelibrary.net to register for those programs. And while you're there, check out all the virtual programs we have for people of all ages. I know it's been a time of transition for all of us, and I hope that you have been able to find creative and meaningful ways to thrive in these challenging circumstances. Just a few housekeeping notes. Everyone will remain muted during the session. We'll take questions at the end using the chat box, and you'll only be able to chat with me as the host. Since we will be recording this session, it is your decision as to whether or not you would like to mute your video. And now it is my pleasure to introduce Dr. Dave Griswold, President of Vantage Point Financial, a financial planning firm in Boston.
Well, hello, everybody. How are you guys? How are you doing? I mean, one thing Ellen did not mention is that I've been a professor of finance and economics for many years at Boston University and at the University of Reykjavik. When I was at Simmons College, I was wondering, as I was teaching the investments class, can I really do what I'm teaching? You know, I had this crisis of confidence at the time, so I decided to leave academia at that time and get into the field. And I realized it's the one premise in education when it comes to economics and also investments is that people make rational choices. You know, once I started working in this field, I realized how emotional everybody really was in the field of finance, and I brought that back to the classroom. So that was very useful. And I do like to practice what I preach. We've been through a pretty rough patch this last March. And the question is, was that a problem or was that an opportunity? And as you're going to see in today's presentation, you really should be acting on that kind of situation that happened in March as an opportunity. This is, unfortunately, there are some tragic things that happen in the world. The market goes down right after those periods. It has come up in the past. We're going to take a look at the wide sweep of it later on. At that point, rather than getting out of the market, sometimes it might be best to do something else. So that's what we're going to go over today. So I'm going to start by sharing my screen. And, we have some charts. I try to keep the charts understandable. But I want to make sure, and Ellen, you can nod your head as I'm looking at you. Can you see that? Keeping your investments? Okay, so we're good, right? Okay. All right, so keeping your investments on track during turbulent times is the topic today. By the way, as we go through this, big question is how much should you be in the stock market? And that really depends on who you are. Some people should not at all be in the stock market depending on what their goals and objectives are. And some people have more opportunity to be in the stock market because they've taken care of their major goals. So that question won't be answered here because everybody's different. But at the same time, if you are invested in the stock market and you feel comfortable with that and it does meet your goals and objectives, the question really is, how should you manage those investments, right? So I'm going to start out before we begin with something I've been using for many years. I know some of the people in the crowd here today are some of my former students too. You'll be used to this. I use Poll Everywhere. So it's, if you have the ability to go from this screen, this Zoom screen, to a web browser, and you're comfortable with that, and you'd have to leave the full screen mode to do it in those moments, you can answer a few questions that I'm going to pose. And it's very much like me being in the classroom in the sense that I can ask the question and get a sense of the class or the group that's participating. And everybody always finds that really interesting, and we can talk about that too. So it's voluntary, it's anonymous, so you don't have to put in your name or anything like that. You can just stay at the screen and not budge and not go anywhere. Let everybody else do the answering, the ones who want to volunteer to do that. And you're going to see the results right here on the screen, right in the PowerPoint presentation. Okay. So it's voluntary. I just want to repeat that. You want to stay on Zoom if you don't want to participate. But if you are interested in participating, you're going to want to exit the full screen mode, and you're going to want to go to this web address, polev.com/Dr. Griswold. I think Ellen is going to put that web address in the chat box right now. That would allow you to, if you want to, just click on that link, and that's going to take you to that website. And you won't see anything to start. You're going to see something like that. So if you follow that link that's provided, or you type that in yourself, that's what you should see, or something close to that. It's going to ask you if you want to accept the cookies. You can say no to that. Just say no to those cookies. Just say no. And after you answer the question, you can return to Zoom. So let's try this out. Let's give it a try. Okay, so first question is, what is your biggest concern right now? So again, this shows you how to get there if you want to go there and respond to the activity. And then when you're done answering the question there on the web page, you want to come back to the Zoom page here. Okay? And I can see right now, for example, down here, we can all watch that. There's one result, there's two results, okay? 3, so it's coming on in. Just let them come in. Yeah, that's good response. So 5 results, now it's popping up. It's good. Good chance for me to take a sip of water. So, after this, I might take a sip of something else. Let's see. Okay. 14. All right, I think that's enough to go on. Let's go with the 15, 16. Oh, suddenly, let's get those responses in there. Okay. I mean, the more responses we have, the better we'll have a feeling for the group that's here. So now, if you've responded, come back to the Zoom screen. Come back to the Zoom screen right here, and I'll reveal the answer. So I'm going to go ahead and lock it. So the 18th response just got in, but there's no, you'll have seen that it's been locked. And let's take a look at this. Okay, just how bad will the economy get? How can I preserve my wealth? Yeah, should I invest now? Market volatility and the impacts on investments? Maybe. The world economics will never be the same again. The market not recovering is a concern. Losing money, not buying cheap enough, keeping approximately stable. Long-term bear market, well, that's interesting because, again, unlike everybody else in the financial field, I can't predict the future. I do have a sense of where it could go, of course, and one big concern is that what if, it seems that the market price right now, where the market is at, is really based on everything coming up heads, right? And the question really is, what if everything does not come up heads? You know, what if it's slower to get the vaccine? What if there is not a very effective vaccine? Then I think that's a very big possibility, long-term bear markets. But we're going to look at bear markets later on today too. So we're going to address that situation and talk about that. So let's go to our next question. You know, you talk to your friends, relatives, and everybody has an opinion, but based on what you've seen, what do you personally think? Do you think that most people in the U.S. stock believe the U.S. stock market will go up, down, stay at this level, or you're not certain about what people think? So we already have a couple of responses coming in. It's up to 3, 6. This one you just have to click on the thing. You don't have to type anything in. Okay, I'm going to go ahead and lock it. And you can change your answer, of course. But I don't want people influencing each other, so I'm keeping this showing the responses after people have answered. So let's just take a look. Okay, go up from here, 21%. So 21% think it's going to go up in this crowd of very limited sample, not scientifically done, right? So if that's the case, you know, and it does go down or remain at this level, and I'm not certain it's a good response, because who knows? It really depends on how they do with that vaccine, right? Do you know anyone who has talked about reducing their position in stocks? I'm going to call it equity, but basically we're saying in the stock market. Just maybe selling right now and getting into bonds, or just moving money into cash or something like that. That's the question here. Okay, and I want to say I appreciate very much those people who are contributing in this way, but again, we don't need a lot. If 100% of you, contributed, I think we would get pretty much the same kind of percentages. So it's just relying on some of us to get this done, right? Okay, so we got 13 there. Unlucky number, I like 14 better. Okay, so I'm going to go ahead and lock this and show those responses. Okay, yes. Okay, so that's pretty unanimous. I mean, that's not unanimous. That is a very strong group of people that, you know somebody who's thinking about reducing the position in equity, because the market has made a comeback, right? Why not, will be the question. We'll see perhaps both sides of the issue later. Okay, so I'm going to start with a mini history lesson first, very mini. At the end, I'm going to show the whole sweep since 1926, but in past market crises, something usually took the market by surprise. Everybody thought the market was going up and they were surprised. In each case, it could certainly have been said that this time it's different. Well, guess what? This time it's different. That's always the case. So the question is, how do we go from there? We know that past performance does not guarantee future results. Now, we know that logically. I'm not sure everybody really feels that, but we do know that. We can nevertheless learn from the past. So here's a brief history of the Dow. What you're going to see here are magazine covers that came out and spooked a lot of people at the time they came out. And of course, people will respond to news. And of course, it's the job of the magazine to get you to take that off of the shelf and buy it, right? Or click on that link nowadays. And they're not going to get it by always having nice news and great news and good news. It's going to be some news like this. But again, a lot of people react to that kind of news. So I'm going to show with these magazine covers also, where was the stock market in terms of the Dow Jones Industrial Average, right? And I think today the Dow Jones Industrial Average is close to 26,000. And at that time it was 929. It hadn't even yet broke 1,000. It's interesting. And then of course, the death of equities. This is what, 7 years later? And you've got the Dow down. That's a 7-year period. It's possible, everybody, that the stock market could be lower 7 years from now, okay? It's interesting when I look at 1989, Japan hit a peak in 1989, and it really still hasn't come back to where it was back in 1989. So it's possible that the market might be down 7 years from now. 1987, when I was in grad school getting a doctorate in finance, we had this magazine cover come out. I was in Professor Bodie's class at Steve Bodie and taking that. We were talking about that whole week, the crash. And at that time, though, the Dow was at 2014. And you can see pretty much 10 years later, it was way up to 7,600, continued to go up. And again, at this point, 1998, a lot of people might get out because of a magazine cover like that. The Dow was at 7,900 at that point. But then we had June 26, 1999. It's not because it's a special date, it's because I could get a nice magazine cover, okay, for that date. And that was, or this particular case, was a book by David Elias, who was very bullish, and that book flew off the shelves. It was a New York Times bestseller. And you can imagine a lot of people getting into the market at that time. Yes, most of us know, and we'll look at this later, the market crashed in 2000, went down further in 2001, it went down further in 2002. But I'm going to skip to 2007, just before the market crash. And all of us here, I have a feeling, remember that period of time, 2007, 2008, the financial crisis. Dow hit 13,000, and then it started to drop, right? And there's not even 2 years, you know, it's down to 7,900. Then we had 2011, that magazine cover came out. And guess where the Dow was then? Well, I had to trick you a little bit. So that's at 12,400, it really came up. And yet there's no relationship a lot of times between the magazine covers and what's happening here. So here we go, a couple more through the period of time that is the most recent. That one I had it flipped just because you could look at the Trump election as a two-sided coin in terms of, you know, will this be great for the economy or could this be bad for the economy? I think that Fortune magazine cover captured both sides pretty well in terms of where it could go. And the Dow was at that point 20,000. Then we had earlier this year, and the Dow was at 28,700 until March 21. Now, special date, the magazine cover came out then, but at the time The Economist came out with that, the Dow had dropped to 19,000 again. So should we pay attention to the headlines like this one? Well, this one came out earlier this month. The Dow will fall back to coronavirus crash level below 19,000 before the new high. That's a CFO survey, and that came out on June 1st. And that means chief financial officers, and they have a great deal of interest in knowing where the Dow might be for sure. They're the experts, but John Kenneth Galbraith, who was a Harvard professor and Nobel Prize winner, said we have two classes of forecasters, right? There are those who don't know, and those who don't know that they themselves don't know, right? So he's saying nobody knows what's going to happen in the future. If that's true, which I think it is true, because only who can predict the future, there's still a way that we can go about this. So, you know, we're talking about market timing. Should we get out of the market before it goes down? We had a question earlier on about that. So basically, should we pull out of the market and just wait to get back in when things settle down is the idea. Well, in grad school, I had to read this for one of the homework assignments, Determinants of Portfolio Performance. And this is a classic article in this profession. The author of this, Gary Brinzen, looked at asset allocation, which simply means how much are you in the stock market, selection, do you own Tesla or do you own Ford, and other things like market timing, should I buy now or should I wait? Okay, so those are the three main things. What made the difference between the Harvard University endowment portfolio manager with their endowment, the Stanford portfolio manager, the Yale, what explained the difference in their performance is really what Brinzen was asking here. So he found that timing only accounted for 3% of the differences between these institutional managers. He looked at thousands of them. Choosing Tesla over Ford really didn't make that much difference either. You know, it was the asset allocation that made the difference, which simply means how much are you going to be in the stock market. So, but let's just say, what would a typical investor likely do if she felt that the market was about to fall? I mean, the typical one. Boy, some people are really quick on the draw here. We got 4 results already on this one. Okay. Okay. Just a few more, okay? Okay, 14. Well, somebody just changed their mind? Okay, there we go. I'm going to lock it so you can't change your mind again. 15, there we go. Show the responses. Let's see, sell or do nothing. That's a lot of sells, right? Okay. Makes kind of sense. If you felt the market was going to fall, you wouldn't buy necessarily. So, but the sell does make sense in that context. And so let's talk about the behavior of investors. So the next slide is going to show news items of a 12-year period and whether investors are pulling money out of the stock market. We say equity market is another way of saying stock market. You're going to notice a red line. And if it's going down, they're taking money out of the market. putting money into the market, that same red line going up. And juxtapose, we're going to show the actual market. Where is the market actually moving during that time period in blue behind? So I want you to take a minute to look at the news items. Just really look at the news items, and we'll also look at the other lines in a second. There you go. All bad news, right? All bad news all the time, right? All reasons always not to be bullish, I guess you could say, or optimistic about the future. And you can see people are responding to these news items because they are definitely taking money out of the market. That can be measured, okay? So this turns out to be 1.9 trillion, 1.9 or 1,900 billion came out at that time. And that, you know, we lived through this part, 2007 through 2009, that was a drop of about 50%. And then the market went up, but people didn't seem to be paying to the market. They seemed to be paying attention to the news headlines, right? Here's a bunch of news headlines over here if you care to read those. But as I mentioned, 1.9 trillion came out. Therefore, they were hitting the panic button, what I call the panic button. And I'm going to refer to this in the next couple of slides here. I can't take it anymore. So back in '73, some of us have been around. You know, I was in college at the time and actually studying in Salzburg at that time. And there was the Middle East crisis that came out. And I was listening to all the reports from here about lines around the block for oil. That certainly did impact the market. It went down 45%. Then we had 1987 when I was in grad school, and I was in, again, Professor Bodie's class, investments, and that was a big market downturn right there, 33%. Then we had the dot-com bubble. We had 9/11, minus 35%. Then we had the WorldCom collapse. Tyco executives. Tyco was the Tesla of that time. Many of you who were in the market may have owned Tyco at that time. It was like rocketing straight up, and Kozlowski was the CEO of that particular firm, and he was perceived as brilliant. He ended up being indicted, so he went to jail, but in any case, at the moment, people were kind of paying attention to that story. And after that collapse, markets went straight down. Then we have all been through this period of time. So from October 9th through November 20th, 2008, we had a market drop of over a half of our money disappeared if we had money in the stock market, 50%. So we have different approaches to this whole problem, to these issues I just talked about. So I'm going to show what would have happened if you just kept your money in stock, which we call equity here. And we're not using the Dow Jones Industrial Average, we're using the S&P 500 index, which is 500 of the largest companies in the United States, and really captures the market even better than the Dow. And we have bonds. So put your, and we're not talking corporate bonds, we're talking about US government treasuries, the safest bonds you could possibly have. And that's measured by that index. And then a balanced investor who has 50% in the market and 50% in bonds. And cash or 90-day T-bills. T-bills are treasury bills. They're very safe. A lot of people will sell in a panic in the stock market and take the money and put them into T-bills. They could put it into cash, but T-bills gives them a little bit of interest, at least during that time period, right? And it can be easily liquidated if you need the cash. Then there's the what we are going to now call the reactionary investor, who is invested in the S&P 500 and who moved into those T-bills every time the market dropped 30%, okay? So market drops 3%, we're going to simulate how it looked if they sold at the moment that it got to 30% drop. And we saw that market actually went down 45%, 50%, so maybe that helped a little bit, right? And then they moved 100% back into the S&P 500, or the stock market is what we're really saying, 2 years later. Now, we could have taken 1 year, we could have taken 15 months, we could have taken any kind of time period you would have, and you would still find some of the same kind of differences we have here. But I do think that, from my own experience, a lot of people, you know, there was a professor at BU, portfolio, He moved out during that 1987, had a hard time getting back into the market, just couldn't see himself going into it. And it's understandable. So we're using 2 years here. So here is a little part of this graph that you can see in the background, but right here is where the market went down in October that we were just talking about. It dropped 50.9% we saw in the earlier slide. And at 30% drop, this investor got out and moved to something safe like treasury bills. And then you can see it's a flat line for 2 years because now it's safe. So the market surely went down further, right? This is a 30% drop and the market went down 50%. Surely that market dropped another 20%. So in that sense, they kind of limited the damage and they went back into the stock market once things settled down, all right? And so using the same approach, we look at a 2-year period here, a 2-year period here, a 2-year period here, and a 2-year period here. It's very hard to see them here because they're so far back in time. And so we have a $10,000 investment, which really doesn't compare to $1 million difference here. We can see the difference is better here. But they're all the same, 2 years out of the market, 2 years out of the market this time. And as you can see, the reactionary investors, $10,000 grew to $400,000 approximately, right? If they had just stayed in the markets and just, had the dip, they would have had $800,000. So that's twice as much money. The balanced investor, remember 50% in the stock market, 50% in bonds, and maintain that balance, had done well too, 586,000. They didn't have the same kind of drops, so that was less volatile, you could say. And then these are US Treasury bonds that we just mentioned. And then these are T-bills, which are the safest. That's what you would have ended up with here. So it doesn't seem like getting out of the market and getting back in it doesn't seem to work. This shows that it's not working in this case. What they're really doing is, I'm going to start here. The market goes down 30%. They tend to sell somewhere in here. And then it starts to go back up and they think, yeah, but there might be another bottom. It might go down again. That's where we are right now. You might have gotten out of the market in March and it's going up, but maybe it's going to go back down again. Once it's up for a sustained period of time, they get more confident and then they buy. But what's the problem with this slide? You're supposed to buy low, right? And sell high. Right here, we see that they're buying high and selling low. And because of that behavior, and this behavior can be measured, like what's the outcome of that behavior? It's been measured by Dalbar, which is here in Boston. And they've shown what the average individual equity investor, stock market investor, has earned for a 20-year period through that period. And I started seeing Dalbar studies about 20 years ago. It's always the same. The average equity investor doesn't come out ahead of the S&P 500 index or whatever the investment they are in. Peter Lynch, some of you know Peter Lynch. He was a very famous investor at Fidelity. He ran a fund called the Magellan Fund, which really had this record that was nobody else could touch back in the 80s. He said, my fund has done great, but the average person in my fund has not done well. And that's because the average person in his fund, when they could see the flows, would skedaddle when the market went strange for them or went badly. And they got back in at the wrong time. So he could actually measure from his fantastic fund how the average investor did. It was very similar to this. And we can see the bond side on the right side, same thing. So I want to assume that you want to have a 60% portfolio because for you, you believe that this is the right one for you. What's going to happen over time if the market's going up constantly? Well, of course, the equities is going to grow faster than CDs or cash. And so what's going to happen is that what's going to happen is that when this market is going up, such as right here, you're going to find that that portfolio grows to 61.4. I just chose that particular point. So if we don't act and the market continues to grow, we're going to drift away from our target of 60% equities in this case. And as we go more and more, as that equity position grows, like if you waited 10 years without touching it, it could be 70% equity, right? So as we don't touch it and it grows and goes more into equity, it gets riskier, right? We might, in fact, want to reduce our risk as we're getting older, though, right? So it is important to monitor and rebalance, what we call the rebalancing of the portfolio. This does two things. By getting back to 60%, and that's what I mean by rebalancing, you rebalance back to 60%, we capture the gains. We're going to see later how to measure those gains by doing that. And our portfolio does not increase in risk, right? In this case, I say volatility, right? So, well, what happened? And I just want to show you one thing about this chart too. See, it's a lot of bad news again, right? Bad news everywhere. Some people pay attention to that. And I'm not saying it's wrong to pay attention to that, but I would be very careful to pay attention to that when it comes to your portfolio. Here is $10,000 invested before the big crash back in 2008, right? So that's a terrible time to invest at the height of a market. You don't see the market here, but it's going up and up and up and up, and now it's at a peak. And from that point on, it goes down 50% over the next year and a half, right? But we can see that it ended up at $28,000 through the end of 2019. That's a rate of return of 9.09%. So even if you invested, now of course it would be better to not invest here, but invest here. The return would have been better, right? But it's still not too shabby for that period of time right there. Okay. So what do we do when markets are falling? Just the same thing. Equity will shrink, right? It will go from 60% down to 55%. What we want to do is buy in those kind of situations. But it's not very realistic just to have a 60% portfolio. I'm now going to give you what's happened from 2005 through the end of 2019. So this is our case study here. Investing in large company stocks, small company stocks, internationally developed country stocks like Sony or Nestle, emerging market stocks like Tencent, which is a Chinese company, Russian companies, Brazilian companies. We have real estate investment trusts, like those trusts that own all that real estate in downtown Boston or Chicago, and then high-grade bonds, okay? Then we're going to have an asset allocated portfolio that is a combination of all these. Okay, so these, we're going to start with these targets. So large cap, 15% there, those other percentages as well. But notice it's a 60% portfolio because I have 40% in bonds. The rest of it is in equity of some sort. So this is a 60% portfolio. And so what would happen if, that portfolio, which I'll just simplify to this without the asset allocated part. We're allocated like this for $100, right? So with $100, you'd have $40 in bonds, right? That's 40%. Well, let's just say the returns happen to be high to low this way. So what is 10% of $40? If it drops 10%, it's going to drop $4, right? And this is going to, this piece, this $15 is going to grow by 20%. But 10% would be $1.50. So 20% must be $3. So this is going to grow by $3. This is going to drop by $4. So there's my $36, it dropped by 4, and there's my $18. It grew by $3, right? And we make all the other calculations in the same way. But notice, still adds up to $100. So, at the beginning of a particular year, let's say January 1, you had $100, and now it's December 31 of the same year, 365 days later, and it's still worth $100. Does that mean you don't make any changes? In actuality, we're going to see it does add value to go back to targets, rebalance, which simply means we want to get back to our target. We know that that's 36%, as we just mentioned, because it's $36 out of 100. And you'll notice that this is supposed to be 40%. Therefore, all the stock must be 64%. We're above 60% now. It's riskier. We need to rebalance to get back to our target. So what are we going to do here? We're going to buy bonds, buy enough to get back to our 40% target. But what are we going to do here? Well, it's done so well, it's really high, it's above our target. So to bring it back to target, we're going to sell some of our large cap, just enough to bring it back to 15%. And we're going to do the rest. We're going to make the calculations based on our $9.50, which I think you can still see. And you'll notice that this is above target. we got to bring it down. This is above target. That's below target. We got to bring it up. So we're going to sell, buy, buy, buy. So buying to bring it back to target, buy the things that went down or didn't grow as fast, and we're going to sell the things that went up a lot. Okay. So here's the actual returns from 2005. Emerging markets did really well. International did well. High grade bonds, they held their pace. When you put it all together, you have the asset allocated portfolio. In this case, $100 grew to $108.90, okay? But it grew in different ways, right? So let's take a look at our targets, reorganized to match what we had before. 10% should be emerging markets, 40% should be bonds. There's our dollars that matches a $100 investment. Well, here, this $10 grew by $3.45, right? So we can see that's $13.45 now. And all the other calculations are made. And now, what is this percentage now based on $108.90? We make the same percentages. Okay, it's done really well. Certainly, we can see that this is above target now. So we're going to have to sell. And we only have 37.6% in the bonds. We got to bring that back up to 40%. So we're going to have to buy, right? So there's our action to buy the bonds, to bring it back to our 40%, and to sell the thing that is too high. Sell at when the emerging markets are high. Sell high, buy low. Okay. And those are the other things that we do that match what we just talked about. For example, this is below target here, so we have to buy. Now, we're going to take 2005 and go forward. Okay. Going to go to 2006 and 7. And this has been a great year. 8.9%, 16.7%, 7.6%. Starting to get a little bit of a rumbling here with the real estate, small cap, but everything else is doing good. So what do we do in this case? I'd like to have everybody think about it. Without emerging markets in 2007 doing so great, what do we do? Must be above target, right? We should sell just enough to bring us back to our target. And what are we going to use the money for? What are we going to put it into? REITs have done so badly, so we got to bring that back up to target. So we're going to buy the REITs. Okay, but I'm going to focus on the emerging markets as the example. We're going to sell because they've done so well. And in 2008, we are so happy that we sold at those high prices in 2007, right? The emerging markets, because emerging markets did the worst, but we sold already, right? But now what are we doing in 2008? We're going to buy emerging markets. It's half off, 53.2% off. So we're going to buy emerging markets to bring it back to our target. And oh my goodness, in 2009, we're so happy we bought at those low prices, right? So we buy at those low prices. We're certainly going to be the beneficiaries of that. We're going to sell in 2009 emerging markets and buy high-grade bonds and everything else in between that I mentioned. So that's the process, right? And so this is what we see for the rest of this period here through 2014 and through 2019. You'll notice that the asset allocated portfolio is never the worst. It's never the best. It's pretty boring, but that's what we like about the asset allocated portfolio. Boring, it's good. And then we take a look at what has done the best over the entire time period from that period, from 2005 to 2019. It turns out to be large cap company stocks, did 9%. I did the same exact slide in 2015. Guess what did best then? It was emerging market. I mean, it was the real estate investment trust. They did over 11%. Large cap had only done 5%. So we just don't know what's going to happen going forward. This period, large cap companies have done the best. Then we have the real estate investment trust, still doing pretty good. And then we have small companies at 7.9%, emerging markets at 7.8%. The asset allocated portfolio is doing 7%. And really, what was the worst one for this? 22.4%. It's dropped 22.4% in 2008. Then we have the international markets in this particular period, 5.3%. If you go from 1970 to to today, or through 2019. International markets and US markets are about the same, but in this period, international is not so high. And then we have the high grade bonds, 4.2%. So when you look at the individual investments, this did the best, but it did have bad 2008, right? And this didn't do so badly, but it had a terrible 2008. When we look at the asset allocated portfolio, it did 7%, and we kind of minimized the risks. The only thing that's less risky than this are bonds, right? Which would make sense, okay? But what if we had just invested in 2005 and didn't do this rebalancing stuff, right? Well, the calculation there would have been 6.5%. So, and it would have gotten riskier. It clearly is at 26% is worse than 24, 22. So the rebalancing does capture value. It does add to value. I've done other calculations for other periods, and so that difference changes, seen it as high as 0.8%, 0.9, and this is the current period right here. So what we're doing instead is, in a very disciplined way, just selling when the market's high to bring it back to target. We're buying when the parts of the market are low to bring that back to target. Very calm, reassuring way to do it. But let's take a look at 1926 to 2019 and see how bad these bear markets are, because that came up in the question that we did at the beginning. Remember, could this be a long-term bear market? All right. So let's look at bear markets, which is described as when the stock market index is at least 20% down from the previous high, okay? And so we have, before the bull market starts, which is after the market has fallen, the next market high. 1929 was no great shakes. That was a pretty tough period, and we didn't have a lot of the knowledge that we have today with the Fed and so on. So there was no intervention in the way that we know it today. But otherwise, how long do they last? Here's a 10-month, 2.1 year, 11 months. They don't seem to last a long time. But here's the most recent one that we've all been through, 2007 and 8 and 9, and it was 1.3 years, right? It dropped 50.9%. But then if you look at the subsequent years through the end of 2019, which lasted 10.8 years, up 451.3%. That is kind of insightful. It gives us some sort of different way of looking at this, perhaps. So we do see the minus 44.7. And so that is over 2.1 years. This other number below it is simply an annualized basis. So I'm just looking at the top number, like what is the real damage done? It went down over that time period, 44.7. But over the next 5.1 years, it went up 108.4. So there's the bull markets. Here are the bear markets. So maybe we are in for a bear market, and maybe it's worse than in 2007 and 8, possible. Past performance does not indicate future results, remember, okay? I talked about Japan already. So I believe this could be bad for the US market, but that's why you want to be internationally diversified. If a Japanese citizen had been internationally diversified, that would not have hurt that retiree, say, in 2008. So I'm going to part with the wisdom of Mark Twain. Most of us love Mark Twain. He said that October is one of the peculiarly dangerous months to speculate in stocks. The others are all the other months of the year. And so it's all over the board, but October has always been one of those months. People are more afraid about it, but he has experience because he went completely bankrupt. That's why he went around the world to, pay off all his debts when he wrote from abroad, letters from abroad. So at this point, I would like to say these Zoom sessions are part of the ongoing You and Your Financial Series, Future Series, and is co-sponsored by the Newton Department of Senior Services. And I will take questions in a minute, but I just want to point out that on July 21st at 7 p.m., Denise McCarthy, who has been to Newton Free Library, and she is fantastic, will be making a presentation on estate planning and long-term care. You can see the details there. what you need to do is go to the Newton Free Library. Maybe, Ellen, you can provide a link to that particular event also in the chat. And then we're also going to have Toby Gerard, who's also great. And so she's going to be talking about long-term care insurance. And that will be at 7 p.m. on August 18th. Okay. Other than that, I can, at this point, take questions. By the way, if you want topics for the next time, you might want to put that into the chat box, suggest it to Ellen, so that we can do that. I'm trying to get this all done under an hour. I think we've got some time for questions if Ellen wants to throw me a question.
All right, I have one question. Should we rebalance annually or more often?
Okay, good question. You can set, by the way, if you have a 401k plan, I would definitely recommend that you have, most of the 401k plans can set to every quarter. So you can quarterly rebalance and it would happen automatically for your 401k plan. But I'm thinking about quarterly rebalancing. For example, the market kind of went down in March, right? To somewhere in the mid-March, around the 13th, 14th. I remember I was buying things that were $119 for my clients' portfolios. Later in March, towards the end of March, early April, I was selling those very same things from 119 one went to 143. If you wait for quarterly rebalancing, you'll miss those kind of opportunities. So in your own portfolio, when it goes down like that, you may want to, go in there. I'd say quarterly rebalancing is better than annually rebalancing, as long as it's costless, as long as it doesn't cost you anything. That's what happens with your 401k plan, or the transaction charges is so low, So the rebalancing is partly based on the cost of it and the size of your positions. I'd say for most people, if they just did it once a year, they'd be way ahead of what they're doing right now. So I'd say on an annual basis, and I gave you an example of an annual basis rebalancing.
So Dave, you've done a fantastic job of explaining asset allocation and portfolio balancing. Someone has written, how does time horizon play into asset allocation?
Okay, there's two schools of thought on that. I know Warren Buffett's 100% in the stock markets. And the reason for that is that even if the stock market crashed by 90%, he would still have enough money for the rest of his life and his charities, right? So there's something called risk capacity. Everybody always talks about risk tolerance, but you have the capacity to take the risk. So it has been perceived by a lot of financial planners and the industry that a longer time horizon makes investing in stocks safer. This is also countered by academic work by Steve Bodie, again, a very influential professor with me, who says that the long time horizon may not make the market safer. We've already seen it for Japan, and therefore may not be the driving thing for you. But I think as a rule of thumb, most people would say that the longer you have to retirement, the more chances your stock has to go up. So if you're a 22-year-old with a new 401k plan, as I've told my students, when the market is down, you should be going, yes, and the reason for that is that you're investing, let's just say $100 a month in your 401k plan. And I'm going to go to the next level next, but $100 a month in your 401k plan, let's just say every share of stock you buy is $100. So over a year, you're going to buy one share per month for 12 months. You'll have 12 shares at the end of the year. If the market drops 50% and you're still investing your $100, well, the shares are now costing $50. So you're buying 2 shares a month. You'll end up with 24 shares at the end of the year. Over time, that will come back, as has always been the case. Past performance does not predict the future. But by the time you're 65 years old, probably it will have come back and you'll have more shares. As you're getting closer to 65, I definitely think you should take risk off the table. I definitely think you should be less risky. And therefore, one way to do that is, for example, with creating your own income stream. TIAA, CREF, a lot of professors in the Boston area across the nation are with TIAA. Many of them convert that into what we call an immediate annuity. And so that is a way of converting your hard-won gains over your lifetime into a steady stream of income that you can't outlive. So that's called a fixed annuity. I do think you should be more out of the stock market for most people as you get closer to retirement. So that's a long-winded answer, but definitely I think you should reduce the risk when you get closer to your retirement.
Well, Dave, the questions are pouring in, and I know you don't have a crystal ball. This
Yeah.
particular participant wants to know, do you think Trump will goose the stock market before the election?
I don't think he has the power to do that. So that's my short answer to that one.
Okay, then next up, are any other economies recovering from the COVID dip?
Say that again?
Are any other economies recovering from the COVID dip? I assume they mean other countries, the economies in other countries.
Yeah, I mean, definitely we know that countries that, base their approach to COVID on a scientific basis, they're doing really well. So I would imagine that those economies such as, well, Germany would be one of them. I'd say certainly New Zealand, they're going to be more productive, right? So if they're more productive, they're going to have stronger economies. I think the Chinese could very well have one of the strongest economies going forward just because of their very strong-armed approach to it. So I do think that depending on how COVID goes and how countries respond to that, some countries are going to come out of it very, very powerfully productive. And I think that really is based on a scientific approach to that problem.
Well, here's a very interesting question. How may deeper US $1 trillion debt influence investment?
Yeah, good question. No, that's a good question. The problem with that loan, I mean, with all this money being dumped onto the economy, is in the short term it works really well, and it's probably very good to do that. In the past, we talked about helicopter money, but now this is really like B-52 bombers coming in, just strafing the entire country with dollar bills. That could lead to high inflation later on, and that's a concern of mine, is the high inflation. We're afraid of that after 2008 also. That came up in my classes constantly. But during this period of time from 2008 to today, we had the Chinese economy just getting more and more productive, undercutting prices, and that did push prices down. But at this point, if we're talking about changing our supply chains, which might make a lot of sense, there was an article that was in the Irish Times the other day by an economist there, and he goes, the 21st century is going to be the century of the pandemic, whereas the 20th century was world wars. The pandemic means you have a different way of approaching the economy. Because of the fluidity of people, if any of you have ever traveled overseas, you just know that Prague is packed with people. All of that will transmit a new unknown virus very quickly. We've had a few close misses with Ebola and other ones. This one really hit us head on. He's suggesting that these kind of things could be happening more often, the jump from the animal kingdom, for example, to humans and then transmitted quickly. So one solution to that, he says, and I think that this is something everybody's paying attention to in business, is should we have a very, very long, tenuous supply chain from China, or should we be producing and sourcing it closer to home? And that's true, the Chinese will think the same thing, and the Germans will think the same thing. If you have supply chains that are coming from closer to home, like with a trusted group of people, a group of nations, those supply chains won't give if suddenly there's a big downturn in transportation and that sort of thing. But that also means higher costs, right? So that could be very, very inflationary. It could be a good thing to do, but it could be very inflationary. So that could really hurt economic growth quite a bit.
We have another question, and I do want to say, of course, we cannot give individual specific advice on the programs that the library presents. However, this attendee wants to know, how do you figure out your asset allocation plan?
Okay. So that is an algorithm. All my students had to do the same exact thing. Basically, I think one thing I have here, I wonder if I have the slide. I hit a few slides, but this one might communicate it pretty quickly if I have it in this one. It's called the efficient frontier. Basically, what do you think is safer? 100% bonds or 80% bonds and 20% stock? And quite surprisingly, it turns out to be most of the time, depending on the volatility, 20% stock, 80% bonds is less risky than 100% bonds. And the reason for that is because of diversification. Bonds can go down in value and up in value. They can fluctuate, just like stocks can. And because they don't move together, you can actually reduce the risk and the volatility by having some stocks, but not too much stocks. So here we have a situation where you have less volatility with 20% stocks, 80% bonds, but you have a higher rate of return because you have stocks. And stocks, as we've seen, have higher rates of return, expected returns higher than bonds over time. We take that to other levels with, so basically it's based on volatility of bonds, volatility of stocks, the correlation between the two, and the rates of return. Those three things: rates of return, correlation, and volatility. We can do the same thing with other asset classes, such as large cap versus small cap. And we optimize it in the same way. So that's pretty much mathematical, but intuitively, the simple thing is, all things equal, the higher the rate of return, the more you want of that particular asset class. That helps increase the return. But the more the volatility of that asset class, the less we want of it, because that obviously will reduce the risk. It's intuitive because we like less risk and we like higher returns. The last piece is the correlation. Do they move together or not? So that's how we put together a portfolio based on those three things. And it's based on expected returns.
A couple of people have asked similar questions, so I just want to double check. Is there a way to figure out your asset allocation if you're an older person and not yet retired? I mean, is it based on your own risk tolerance, or is there a difference from what you just explained?
Well, there's this one way that most of the profession does not go, but I think it's a very strong argument that, again, Svibody makes, Professor Svibody, if you want to Google him. He believes that you should have a bottom fundamental layer of something that you know is going to carry you through for the rest of your life without any risk at all. And he has suggested inflation-linked bonds. You reduce the risk of inflation, which was brought up as an earlier question. What if we have 18% inflation like we had back in 1983? Because I was getting my own mortgage wrong then, I remember. What if you have that high inflation? Well, inflation-linked bonds will keep up with the inflation, so you eliminate the inflation risk. And it's U.S. Treasuries, so you eliminated the country risk pretty much. So if that can take you all the way through retirement, you shouldn't put any money in stocks. But if you have more money than that, go ahead and risk that in stocks. So that's a very simple way of looking at how much should be in stocks. Is like, I don't want any risk, put it all into Treasury, inflation-linked bonds, or the fixed annuities I talked about to take away the longevity risk, and the rest goes in the stock market. There are things called Monte Carlo simulations, but in the end, they're all flawed because they're based on past performance. Again, we could have a situation like Japan, and the market could be lower 20 years from now. So I do like the safe approach myself, personally.
Dave, we're just about at 5 o'clock, and we do have 2 more questions. I hope you'll have time for just quick answers to the last 2 questions.
Mm-hmm.
One is a comment and a question. The comment is, the market did so well last year that I got hit with gains, bad for taxes. This year, I was able to take some losses when I rebalanced. That will help next year. Could be an option. The question is, how do you feel about mutual funds versus stocks?
Stocks are not efficient in that they have a lot of risk associated with things that can come out of nowhere, like lawsuits, CEOs dying. Consumers can turn on a dime. You take a look at Polaroid. I had somebody who really loved Polaroid because he worked there, but consumer preferences can turn on a dime. I think the better approach really is to own every company in the world. So like, for example, if you have an index fund that owns every company in the world, you really don't care. Let's just look at one industry. You have like the automobile industry. People have to buy automobiles. They do every year, electric or otherwise. If you own all those companies through a mutual fund, then you're going to get the earnings of all those companies, right? But let's just say Ford goes out of business. Well, people who used to buy Fords are now going to buy GM, or they're going to buy Toyota, or they're going to buy other cars. If you own all those other companies, they simply shifted the earnings to you from Ford or GM to these other companies, right? You reduced the company-specific risk, we call that, just by owning every single one. So I think it's much preferable to own every company in the world through an index approach to keep your costs low. It also hits the other question you had, capital gains. If you own, say, exchange-traded funds that are index funds, and you just buy and you hold, there will not be capital gains. You know, but if you own an actively managed fund where the manager's selling and buying all the way through, you might very well have capital gains. So you can avoid the capital gains, I think, by just using index funds. You can minimize the capital gains, I should say, by owning index funds.
That was a great explanation, Dave. And this is our last question. We have unfortunately run out of time. Can you just speak briefly about T-bills?
Yeah, T-bills, they're treasury bills. They basically are, you can buy 3-month T-bills, for example. You can Google this and find out more about the T-bills, but they are investments with the US government. They will pay very, very little interest because they are so safe, but they are totally liquid. Now, if you have, say, $300,000 in your bank account, you know, you got $250,000 is guaranteed because of the FDIC. On the other hand, if anything happened to the bank, it's going to take some time to get that $250,000. But with T-bills, you could sell them the next day, and you're going to get exactly the value for those T-bills. So it's a very, that's why major flows of money go into T-bills from stocks, because the institutional managers and the average person can trust the T-bills to maintain their value and yet be liquid enough to, say, sell and get the cash to go into something else.
Well, Dave, thank you so much. We'll be wrapping up today's session now. I do want to thank the Department of Senior Services and my colleague Ilana Seidman, who has been helping run this program behind the scenes. And thanks to all of you for coming. Of course, there are many programs that are offered by both the Department of Senior Services and the Newton Free Library, so please visit our websites and do register. We look forward to seeing you at some of our future virtual sessions, in particular the upcoming Financial Future Series sessions in July and August. Have a good night.
Thank you for having me.